is a safe haven, best performing asset in human history. Again, all those things are true if you bought it in like 2010, but just because you bought it like 6 months ago and you're whining that it's down 50% and it's a very volatile asset because, the world changes, then you start blaming other people. And every cycle it's a new boogeyman. And so I guess the cycle it's always the market makers.
Yeah.
Lots of assets go down in price until that situation happens. But if we're talking about an asset that is very responsive to liquidity, when that liquidity is going to be provided to finance certain aspects of the war or the rebuilding after the war, then that is inflationary, and that is what is going to carry Bitcoin to much higher levels in fiat currency terms.
Yeah. Arthur Hayes sees a big opportunity forming where AI and crypto come together. The idea is simple. AI agents will start working on their own buying services, completing tasks, and paying other systems without human involvement. But traditional banking systems are too slow and restricted for that. They can't handle instant, global, machine-to-machine payments. That's where crypto becomes important because it's fast, programmable, and borderless. According to Hayes, this is the emergence of an agentic economy in which AI systems communicate and do business directly with one another. Additionally, the cryptocurrency industry may see a surge of new stories, coins, and opportunities as a result of this change. But there's an important warning. Most of these new projects will likely be hype. Only a small number will actually survive and become valuable. Please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this.
I don't know what the trigger will be. I think it's going to be in sort of these smaller banks that will have more exposure to these types of loans and who don't have the government guarantee. But to your point, there is no appetite for any whiff of deflation or a credit event. And so if we even start to see a few banks wobble, you are going to see an immediate response from the Fed and the U.S. Treasury and other regulators around the world to sort of ring fence this problem because they don't want to suffer anything like 2008 again, which is why this can happen a lot faster than people think, because the response is almost immediate, right?
Yeah.
A few days, and then here is a blanket, sort of bailout for the banking system, and that's going to happen. Except in this case, this is a structural problem with you have on one hand every single major government saying AI, AI, AI. We have to win the war against AI. We have to upgrade the capability of AI, and the first casualty are your workers who have the highest propensity to spend. And this is government policy. It's supporting the build out of all this CapEx to make these LLMs faster and cheaper and all these things. So and you could go back to 2008 as well. It was government policy to get as many people in homes as possible and loosen the underwriting standards and force banks to get into this business. It's government policy for us to underwrite AI at the national level, regardless of where you live. And therefore the consequences are going to be massive. And again, it's the government pushing this as well. It's not just entrepreneurs who say we have to do AI, but it's path dependent, meaning that sure you need to get to the bailout, but to get to the bailout you need the crisis. And so things need to go down and price pretty quickly, and that's what Bitcoin is telling us. There's not enough money being created. The authorities still believe that AI is this productivity tool and will help them escape the debt that they have to pay back because productivity is going to elevate so fast per worker. But they don't believe that there's going to be mass layoffs or enough to cause an issue in the banking system. And so there's the economy there, and that's what Bitcoin is telling us. They're not printing enough money to counter what is going to happen in the near future. Until they get to that religion, oh no, I need to print more money, then Bitcoin is going to be at these levels or maybe even a bit lower. We'll see.
Yeah.
And I've written an essay about 4 weeks ago about my read on the reason why Bitcoin has underperformed sort of big tech, NASDAQ, and gold, and it's pointing to a liquidity destruction or credit event that's going to be sponsored by, in my opinion, the displacement of knowledge workers, especially in Western economies, due to AI.
So you see a massive job displacement, meaning people get displaced and then they have to find a new job, but there's sort of like that in-between spot, and that creates massive unemployment to spike, tax receipts plunge, and then the government has to come in with a massive stimulus?
I mean, I think it's more akin to, we have a small increase. Maybe it's, well, I don't know if small is the right number, but an increase. Say it's like 10, 20% of people who lose their jobs because of AI automation, and they have credit to service. Mortgages, credit cards, auto loans. Especially in the United States, where it's a very flexible labor market, and consumer spending is something like 70% of economic activity, and most of it's leveraged, then when you take the highest earning income group, knowledge workers, people who had a university education, who are doing some sort of like knowledge work, computers, lawyers, accountants, what have you, and you're taking out sort of the least productive members of that class, and you're saying, well, there's nothing here for you right now. Maybe they will have been retrained, call me in 3 to 5 years, but that credit card payment is due next month or in 10 days. And where's the bank going to get those funds from to service that debt? That's that asset on their balance sheet. And I think that's the issue. And it's not that everyone loses their job because of AI. It's we only need a small percentage of people to lose their job for the leverage embedded in the system to take over and cause a financial panic. And that's the point that I'm trying to make.
Yeah.
And the question is, how long will the Straits of Hormuz be closed? Or how long will it take to restart energy production in a lot of these Persian Gulf producing states once the war gets to a level where they feel comfortable going back and rebuilding things, right? That's all that is the question that we need to answer as investors. Again, it's very difficult to understand how that plays out. But the longer that the hostilities remain between the United States and Iran, the more disruption there will be to the energy flows. And at some point, because of the negative economic effects of that, I believe that the Federal Reserve is going to be forced to start printing money. And now it won't be like they'll have an excuse, whether it's the US needs to build more refining capacity, needs to build more drones, needs to mine more stuff, whatever it is that the United States needs to do more of to not have another similar situation where you have the desire to win a war very quickly, but the abilities don't match that desire. And so you still have this standoff. And what do you do about rebuilding this region, which supplies 20% of the world's oil or something to that number? I think that's the question. And we can basically just watch the oil price and how that interacts with the U.S. Treasury, the 10-year Treasury, to understand when there's going to be a policy response. So if we start getting oil at like $150 and the 10-year Treasury yield is moving towards 5%, there's going to be some sort of money printing activity. And I don't know how it's gonna what it's gonna look like, but again, the system can't handle those two things happening at the same time.
What if the true danger in cryptocurrency isn't volatility, but rather a misinterpretation of how the system functions? At the moment, investors are attempting to make sense of every move, markets are feeling uneasy, and liquidity is tightening. But this isn't just another perplexing cycle, according to Arthur Hayes. It is a foreseeable result of central bank policies, global money flows, and liquidity circumstances operating as they always have. Because liquidity is the one force that subtly drives everything behind all the noise of interest rates, inflation headlines, geopolitical unrest, and tech euphoria. Furthermore, according to Arthur Hayes, the entire cryptocurrency market begins to take on a completely different appearance if you comprehend how liquidity increases and decreases. In this video, we break down Arthur Hayes' perspective on where Bitcoin and crypto markets could be heading next, and why moments like these often set the stage for the biggest moves in the cycle.
Accelerates the long-term trend. Wars are inflationary. And so everyone now has to have their own energy supply. They can't rely on the global energy markets. They have to have their own food supply. They have to have their own logistics supply chain, right? This is, as we keep disrupting all of these nodes of global commerce by these wars, everyone now needs to have their just-in-case inventory. And that's inflationary at a secular level.
Yep.
The over-leveraged system cannot support the amount of debt that's going to need to get issued to finance that. And so it's going to be inflationary. They're going to resort to printing money. And every war, the government prints money. They start doing it at some point. They don't start out that way, and obviously, lots of assets go down in price until that situation happens. But if we're talking about an asset that is very responsive to liquidity, when that liquidity is going to be provided to finance certain aspects of the war or the rebuilding after the war, then that is inflationary, and that is what is going to carry Bitcoin to much higher levels in fiat currency terms.
Yeah.
I definitely think we could get a much lower Bitcoin price as this conflict drags on before you get the realization that, yes, the US and all these other countries are just going to print a lot of money to make sure that they can build out whatever they need to build out to fight the next war.
Yeah.
Just wait for the scheme, whatever it is, whether it's the Fed or the US Treasury. Wait for them to tell you, oh, there's an issue, whether it's the markets are down or something broke in the credit markets, and they've responded with something. I don't know what that something is going to be, But if you peel back and you just look at, at a first principles basis, what are they doing? Are they printing money in some way, shape, or form to sort of smother the impact of the market? That's when you know it's time to go long.
Yeah.
And obviously, I was one of the people banging the drum saying there is no 4-year cycle this time. And obviously, shit's down 50% since I was talking about that. Oops, whatever. I don't use leverage, so it's whatever.
Yeah.
But at the end of the day, yes, it's always a liquidity issue. The technology works to the use cases that it has presented itself right now, but it's always been a liquidity story. The reason why Bitcoin has risen so fast is because the central banks, led by the Fed, starting in China in 2008 and post 2008, have been printing lots of money, and we have an asset with a fixed supply that is risen markedly in price. So it's always a liquidity story. The liquidity situation that I believe we're in right now is one that is this AI deflationary event that needs to be underwritten by printed money. And until we get that sort of realization by the central bankers that the alternative is way worse than, continuing the game of printing lots of fiat money, then we're going to be at these levels. But again, I have full confidence that central bankers want to maintain the status quo and don't want to allow a 1930s style deflationary collapse.
Yeah.
Market makers are trend followers and liquidity providers. And so if you're a market making job, your job is to buy low and sell high and do it, millions of times because you're putting in orders every second, or obviously milliseconds, nanoseconds, that sort of thing. And so their job isn't to go long or short Bitcoin. Yes, there might be a trader at the same firm who has a mandate to take directional risk, but the market maker, the person that's providing liquidity that allows you to get in and out of position with low slippage, that person or firm is literally just trying to make the spread. And they're not trying to take a view on the price of Bitcoin or say, okay, I'm just going to slam the price down and bring it back up. It's just not, Bitcoin is way too liquid of a market to do that. Yes, there are some shenanigans on, some shit coins, but most of those shit coins deserve to be zeros anyways. And so they're just being propped up with artificial liquidity because there's actually no real buyers. And I guess a lot of people experience that after the 1010 issues on Binance and a lot of other altcoin and shitcoin trading platforms. But if you want to talk about Bitcoin, the multi-trillion market cap market, there is no one market maker that is taking a big enough directional position to influence the price, causing it to go down 50% in 6 months or whatever it has been from the highs in October till today. Yeah, I've been doing this for a long time, as I mentioned, and anytime a lot of traders lose money on what they believe is the surefire thing, meaning I was told that Bitcoin is a safe haven, best performing asset in human history. Again, all those things are true if you bought it in 2010, but just because you bought it 6 months ago and you're whining that it's down 50% and it's a very volatile asset because, the world changes, then you start blaming other people. And every cycle it's a new boogeyman. And so I guess this cycle it's always the market makers.
Yeah.
It was these no-name, faceless market makers who always manipulate the price down. They never manipulate it up, because you're usually long on leverage. And they point out all these stories. Oh, this person was doing this trading strategy or that trading strategy. Maybe some trading firm got reprimanded for something. But to be able to control a multi-trillion-dollar market, Bitcoin, with one shop and put the price anywhere you want, I think is a bit ludicrous. And so, yeah, I don't think there's anything there. It's just traders whining that they didn't make money when they thought they should have, and they're trying to find somebody other than themselves to blame for their losses.
Yeah.
I wrote a series of essays last year, maybe a year before last, about how Asians are not going to use fiat currency rails. They're going to use some sort of crypto rails. And I think that Bitcoin is the best currency for Asians, but it could be something that they create themselves. We don't know. But what we do know is that it's too slow to use our systems, our legal system, our banking system. If you want to talk about autonomous agents doing the things that we want them to do, at the pace we want them to do it at, we don't want to wait 2 minutes now for our agent to do something. Hey, I want that flight booked immediately. I want that hotel. I want you to have done whatever. AI is supposed to be this revolutionary thing. Why is it not working fast enough? That's where we're gonna get to in terms of our impatience with AI. And so if an AI agent needs to go and use services of other AI agents across the internet, they cannot use any of these systems that we use today. They need to use something cryptographic that is fast enough for what they need to do and what we expect them to do as people essentially employing them to do our bidding. And so I definitely believe that there's going to be a massive agentic economy that's going to use crypto rails. And it's going to be an interesting narrative because I'm sure a lot of payments solutions or bridges or stablecoin issuers are now going to sort of try to slot themselves in on this narrative of like how there's going to be all these agents using their stack and therefore they deserve this particular valuation because you assume this many transactions, right? And so I think that's going to be a major narrative that is starting to gain steam now that we see what these agents can do for us, and now there's this like rush to have your own sort of instance of Claude bot, and there's like some like mania in China. People are going and signing up to use their open source Claude bot to do stuff, right? So we're creating these agents faster and faster. We're going to use some sort of cryptographic rail. Which one? I don't know, but there's going to be some standout projects, at least from a narrative perspective, that are going to attach themselves to this, and we're going to say, oh, that's going to be the solution to the agentic economy. Whether or not it actually happens is not the point, but we're definitely going to see a few tokens really pump on that narrative. I don't know what those are yet.
Yeah.
Arthur Hayes is saying that Bitcoin's recent weakness compared to stocks and gold isn't random. It's a warning about liquidity in the global financial system. He believes the real risk comes from AI-driven job losses. If AI starts replacing a portion of knowledge workers, even a small percentage, many people could lose income but still have debts like mortgages and loans. That puts pressure on the banking system because those debts still need to be paid. In his view, modern economies are highly sensitive to this kind of stress because they rely heavily on consumer spending and credit. So even limited job losses could trigger financial instability in certain banks, especially smaller ones. Hayes thinks governments won't let this turn into a full crisis. If things start breaking, central banks will likely step in quickly with money printing and stimulus to stabilize the system. That's why he sees Bitcoin's current price action as the market waiting. Not enough liquidity is being created yet to support risk assets. He also connects this to bigger risks like energy shocks and geopolitical tension, which could add more pressure to the system and force even more money printing later. On the crypto side, he believes the next big opportunity is in AI plus crypto and new decentralized markets, but most of it will be hype. His strategy is simple: wait for clear winners to emerge, then follow the trend instead of trying to guess early. If you find value in this content, please take a moment to like the video, subscribe to the channel, and turn on post notifications for more videos like this.